Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Thursday, February 3rd, 2022. It is 12:01 Eastern Time, so just after noon as I'm starting the video. About halfway through the day, and for the rest of the day, we'll probably grind around somewhat, would be my guess. Maybe more selling nervousness, but we're already down almost 3% on the NASDAQ 100, which is usually, unless we're in full-blown panic selling mode, that's usually about the floor, give or take. And Amazon is coming up tonight. I'm not going to go over the charts Amazon because I gave you a detailed post. We'd just be wasting time in the video. You know my thoughts. Bottom line is it is back to, shoot, I'll just hit it real quick. Might as well for the video, sake of the video. We're back testing. Really, I'm looking at the weekly charts nice and clean. You zoom in nice and tight. These are the levels. So you have this big level here. Remember, this was a multi-month, almost a year, multi-year and a half, over a year long complete tight sideways trading range with two false breakout attempts. Failed to break out of that range and failed attempts to, well, they were new highs, but then they got rejected. Now, who knows? Everyone sees what they want to see. A bull will see that think, and it could prove that this is a whipsaw to the downside. Only time will tell. But what I can tell you with certainty is, number one, it was a breakdown below the recent range. That's a check mark for the bears right there. That in itself. A nice little check mark because that was, again, big range. And you also, before that, you had this nice clean up trend line, right there. And that's my alternative scenario. And then this trend line here, it goes way back. And that's why I gave you 3 different charts, because this blue line is a secular bull market. It's super well defined, a beautiful trend line that comes off the day this stock it became public back in the late 90s. And so lots of reactions. And then this one I think is equally as important, because this one is a super well-defined, very well-defined off the November 2008 lows. Remember, the market itself bottomed, or the S&P bottomed in March of 2009, small caps, but most people aren't aware. The tech, NASDAQ 100, and most big tech stocks, they actually ended their bear market in '08, and that's when Amazon did, and all the FANGs, they moved together. And this trend line here goes there. So what's happened when you zoom in is you took out on a weekly closing basis. Again, that's why I'm on a weekly chart. It wouldn't matter if it was intra-week. Solid break below there. We went below the trend line, traded an entire week below, and we're currently back testing. Now, of course, anything can happen. These were breakouts that failed. Maybe this one fails, but right now, let's take it on face value, especially considering everything else that's gone on in the markets recently, all the other check marks that we've had. And so far, as time goes on, this thing's playing out almost perfectly. I'm trying to thread the needle, hit these price targets, bounce, try to determine where the bounces end. That can, it's not easy, but there's a range. And, if you're frustrated in that range because it's been a few percentage points from the minimum bounce target to the top bounce target, really from the 38.2 fib to the 61.8, or the NASDAQ actually stopped at the 50% fib, so it's not much of a retracement. It is in percentage terms if you're heavily invested, but again, I've already shared my thoughts there, and I'm speaking to the market now. So that's it. Look, all I can tell you, and this segues into what I'm about to show you, is the charts right now, I'm taking things on face value. Sometimes I will use biases to dismiss a bullish development. There's breakouts that I not only won't take on the long side, but I'll turn around and short into or wait till they fail, because I think they're going to fail based on technicals such as negative divergence, overbought conditions, and all that. Likewise, there are breakdowns that I will not short, or I'll look to go long if they prove to be whipsaws. But in this case, there's just so much evidence pointing that this is the real deal. I'd rather be wrong and get stopped out. And again, I'm not trading Amazon specific. I'm just hitting MQs, mainly. But I'd rather be stopped out and wrong than to not be short at this point in time. And then, as I mentioned this morning, if something, if it pops after earnings, then you have pretty big resistance there. It would be ideal to see it right here on this back test, again, just below the trend line right there. We've already back tested the trend line this week, and you can see, again, a weekly candle, and we're back below it and poised to close. So let's see how Amazon trades. The charts, to me, are pretty clear. It's indicative, no matter what happens today after the close or even in tomorrow, that that the next big move, whether it's this first and then this, or just this, it's going to be to the downside. And on Amazon, from where we're at today, probably come down here. There is that long-term trend line, but I think we could easily break that on an intra-week basis and even still recover it and close back on or above it. But price support's all the way down here at about 2043, and that again meshes with my roughly with my deeper targets on the Nasdaq 100. So there it is for you guys. I said I wouldn't talk about it, but I love this stuff. So anyways, back to what we're at. All right, so let's just look at where we're at on the markets. Oh, and I told you I was going to segue into something. Let me just go to that. So I had a question from this subscriber who said, hey, are you saying, Randy, that you expect a miss from Amazon? Thanks. My answer was, no, I have absolutely no idea. In fact, Amazon, like Apple and all these big things, they're earnings juggernauts. I expect incredible earnings, probably record earnings. But again, that to me is irrelevant. So I went on to say, no, I have no idea whether they miss or beat, although that's irrelevant. I've seen companies come in way above estimates only to be sold off shortly or immediately afterward. And I've seen companies miss by a mile only to bottom and rally from there. And that usually is, let me digress. So that would be, if a company's been in a prolonged downtrend, a bear market, for example, usually bottoms on awful news. And what happens is you reach a point, that equilibrium, or really the shift between buyers and sellers, when just all the weekend longs are flushed out, everybody's bearish, there's excessive short interest, and that's where a stock tends to bottom. Remember, there's a saying in the stock market, it's always darkest just before dawn, and I like to use a corollary to the inverse to that, saying it's always brightest just before dusk. In other words, companies tend to top on rosy blowout earnings, record earnings, and that's of course at the top of bull market. And stocks always look out 6 to 9 months ahead. So again, it doesn't matter whether they blow the cover out of the ball. And then I went on to say, also keep in mind that some companies beat expectations with the stock initially rallying in the pre or post market, and that's right when the earnings are released, then only to reverse hard following the conference call after the company provides forward guidance or something else that investors don't like. And that again goes both ways. Sometimes the company will miss earnings, the initial reaction, the stock tanks, and they come out with something in the conference call or the guidance they give, and it reverses. So bottom line is, all that matters is the market's reaction to earnings, not the actual earnings, and not really the initial reaction, but how the stock trades in the days to weeks following. As such, one might opt to hold back on adding or initiating any shorts until tomorrow or early next week. The pros to that strategy, you potentially avert getting caught on a bullish post-earning rip on Amazon. Remember what happened when Apple blew it out the other day, last week? That's really, was also timed with the charts. We were coming off T1, but it ripped pretty hard, and it caused the entire market to rip with it. And the downside to that strategy, again, if you're assuming you're bearish, is that Amazon pulls a Facebook, referring to what happened last night with Facebook, and then you end up with a much less favorable entry shorting the indexes on a big gap down tomorrow. Let's say you don't trade futures and you don't jump in there, or they tank so fast that you don't have time to, and so that's the downside. So I went on to say, for me, as of now, it still appears that the next 10 to 20% move in the market will likely be down before up. And as such, I'm going to stick to the swing shorts I have now, and I'm going to add or subtract to those positions depending on how things go after today. In other words, I don't want to see Amazon exceed that back test of that trend line I showed you above. I'm about to show you levels on QQQ and SPY, which pretty much we hit yesterday. Some pretty good levels, and so far the fact not just that we reversed off those levels that I pointed out, the 50 and 61.8 fib on QQQ and SPY, price resistance as well, but it was an impulsive reversal. And if you think that, oh, Randy, that was just random luck, no, I can tell you this. Yes, Facebook was the catalyst, but I've done this long enough to tell you you just have to almost take it on faith. Like people that are very religious, you just got to believe, there's God. You need to take it on faith that the technicals and the fundamentals they're interwoven. They go hand in hand. I can't tell you how many times I've seen that where you have a bullish or a bearish chart setup, and sometimes it remains bullish or bearish that setup for a while, and it's that fundamental catalyst that triggers it. But they also tend to come together too like that. Like, markets rallied hard right up to where Facebook reported, happened to right when the report came, we were right at those levels, and then, or I'm sorry, right before that, yesterday morning, and then the big reversal. So, with trading, you can try to guess and predicting, and that's what it's all about at the end of the day. There's no certainties. You just put the odds in your favor, and then you take those, you take those shots at the high probability levels. Like an example yesterday, and at what you believe to be. That's why I always laugh when people say, "Oh, just trade the market. Don't have any bias. Trade the charts. Trade what's in front of you." No, because if you didn't, after the rally we had in the last couple weeks, you would have been bullish and long, and you would have got clocked when the markets rallied into those key fibs and resistance. So, that was a level that, my bigger picture says that the bounce over the last week or so was a counter trend rally. So I should be, instead of buy the dips mode, I should be sell the rips. So in other words, short rips into resistance, and that's what we did yesterday morning, and it worked out. Now, if it didn't work out, there was the next levels above, which would have also provided the next, and what I referred to as probably the last objective shorting op. And what I mean by that is that those were the points where I said I would not keep shorting at that point. It wouldn't guarantee that that we can't go a little higher and then fall, but so that's what that meant. Hopefully that's all clear to you. And so so I said I'll stick with the swing shorts that I have now, and then add or subtract to those positions depending on how things go after today. Because again, remember we're getting close to pushing the upper limits of what should be, and I'll put that in quotations, quote, what should be a typical counter trend rally. That's what I spent time yesterday in the video showing you, the two closest examples, not cherry picking, drops that were comparable the initial leg down on much bigger corrections, and showed you that this is just as impressive as the rally was over the last week or so. It was a typical 100% in line with the previous counter trend bounces in both Fibonacci percentage retracements as well as Fibonacci retracements as well as percentage gains. And then I went on to say, last but not least, risk-averse traders, although that's an oxymoron. If you're a trader, you're not risk-averse. If you're risk-averse, you shouldn't be trading. You should be put all your money in CDs or a well-balanced portfolio and not do what we do. That's the whole nature of trading. You're taking risk to profit with return. So they might opt to wait for some additional bearish or bullish events, before taking or adding to shorts or longs. So what does that mean? Well, I've given you levels overhead that if we're taken out and we keep going up from there, it's going to give more check marks to the bullish case and the odds that we're going to go to new highs, and that the drop that we had into the recent lows was it, and it was just another correction, another buying opportunity in a very strong bull market. Again, we still have long-term indicators that have yet to roll over. They're still bullish. So, however, on the flip side, should we have another impulsive leg down, we go out, take out the recent lows with conviction. We're going to take out some key support levels, and that's going to give additional check marks for the longer-term bearish case and increase the odds that we're going to then go down and hit my any or all of my deeper targets on the NASDAQ 100 and S&P 500. Okay, and then a quick look at the bigger picture, not the longest term chart, just our daily charts. This is QQQ. I'm going to turn off, well, no, I won't turn off the lines. All you have to see here is I have the levels turned down. We have the 200-day simple moving average right here and the 200-day exponential moving average. And this is more than common. We popped it for a single day. I've showed you previous comparable corrections, again, those bigger corrections / bear markets in the past. And when you come and back test it, once in a while you'll get a perfect back test, but quite often you'll pop it for a day, even a couple days, and then so all you can say right now, it's a rejection. We popped it for a single day, closed above it. That's the 200 is right there. That's the 200 simple, 200 exponential right below it, and now we're solidly below both. So to me, that is a break solid break too of the 200s, and simply a back test on the Qs, and now a rejection. So that's what happened to the Qs, and the SPY was ahead of it. Remember, SPY retraced more in percentage terms, 61.8 fib retracement from the initial leg down. But you can see on SPY, the box is right here. This is the box, and that box defines the trading range that it set up this after this breakout. So this was an all-time high back in late August or so, and that level is roughly 453.75. We broke out right there. We back tested here, a little dip below, but still back test, and then boom, we broke down and gave it up the ghost. Just like the Qs popped the 200s for a single day, and the takeaway, if nothing else, again, maybe they're going to keep going, but right now, if I'm right, then that is a great example why you need to be a little bit loose or liberal with your stops when volatility is high, because it's the norm, especially in a, I call these momentum fueled overshoots. You had a, near vertical launch, once we hit those first targets, especially once traction, we held on them, consolidated for a few days, then Apple blew it away in a big move up. And so there's what that does. What I see is a beautiful, I like that even better than a rejection right at those levels. Why? Might sound a little contrarian, because that's a stop clearing move. If a lot of other traders were looking at that level, as I was, as well as the 200-day moving averages on the NASDAQ 100, both got taken out for a day. And if they had tight stops, because they're mechanical traders, they said, well, I'm going to stop out if we take out those 200s, and I'm going to stop out if we take it. They were stopped out. And I like to be a lone wolf on the short side, because when it's a crowded trade, if everyone else is singing, chanting, the short song, and everyone's shorting, guess what? There's too much short interest, and that's where the market won't go down anymore, or you get caught in a powerful short squeeze. So especially if the shorts were cleared out, and I have little doubt that a good percentage of short interest was cleared out on this ride up, and especially on that last final day there. And again, that sets the stage. It doesn't guarantee it, but it opens the door for those quicker sell-offs, especially not only shorts being cleared out, but you have longs that say, oh great, the 200 days got recovered on SPY. Oh great, that the bottom of that trading range is recovered. This was just a big a correction, a buying opportunity. And those are what we call weak-handed longs. They bought in, now they realize they're long, and so they start selling. At the same time, the shorts that in hindsight wish they would have shorted that, they start piling in, and because you don't have a lot of short interest, that's where you can get those big moves down. And that's also the nature of most corrections. If you're going to get even if you want to just say an ABC like that, you're going to have a pretty big wave down. And anywho, I think that it's there. The potential's there on the charts. There are no guarantees, guys, and that's what stops are for. And again, we're pushing the upper limits of the bounce targets, but we didn't exceed them yet. And so we'll see where we go from here. Wanted to show you one other thing. So I showed you SPY right now back at the bottom of that range, right? And QQQ falling back below the 200s after testing. So that's kind of the big picture. Amazon's probably going to have a big hand in where we go from here. So again, just caution you not to overreact to the initial reaction. Although it would be nice if it would be nice if it was something along the lines of Facebook. And again, technicals tell me that's most likely the case, even if we get a one or 2 day pop, that we'll probably see more downside. But all the better if it just craps out after earnings, because again, especially on the heels of today's gap down, these gaps are powerful instruments, I think, during a correction. Just like gaps up are on a bull trend, again, it leaves behind. Denies entries to shorts. Everyone's saying, oh, well, I should have shorted yesterday, but you know what? I'm not going to short today. It's 3%. I don't like that entry. I'll wait for a bounce. Or the longs that are trapped. They want to wait for the bounce that never comes. And that's what makes bear markets so darn profitable to trade in corrections, because you just get that quick drop. I've talked about it before. You drop, right here in a matter of, my measuring tool tells me that was 21 days. Actually 14 trading sessions, 20 days, 13 trading sessions from that point there. We dropped 17%, and that in just a couple weeks there, we wiped out gains going all the way back until last summer right here. And that's again, you look at history, that's nothing. There's some a lot bigger ones that fall a lot faster. And the thing is, you got to be quick. You can't wait too long. If we start going down and snowballing, we can come down. Then we turn our focus back again to the weekly chart, and that T2 is all the way down there at about 299, call it 300 if you want. So if you shorted yesterday morning, you're good for about another 18% drop if we get it. But I'm just going to leave it here, and then we're going to look at gold and silver and the dollar and euro. So I'll say the same thing I keep saying: support is support until it's broken. So. But we take that out, and that's pretty much, we get a pretty impulsive reversal here. As long as I don't see anything really bullish in the charts, I'll point out any divergences I see, things like that. But we're already getting to that point where these bullish divergences are starting to either not play out at all or play out for a lot less than they used to. I talk about all these dips back here each and every time almost. You can go back on the site. We had bullish divergence on the 60-minute chart, and that was a catalyst to the new highs. And this time around, so far, it was nothing more than just a little, marginal, normal counter trend bounce, far from the previous highs. Okay, let's look at gold and silver. Before we even do that, let's talk the euro. Okay, over the last several years, and I probably should have traded more. I'm going to toot my horn here. I've had some I think excellent calls, timing on the bigger trends for the euro and the dollar, all these wedges, and capture a lot of the big trends. And yes, I was looking for after this being bearish here and calling that pullback, I was looking for on the back test of this trend line. I thought we might go on and take out this longer term trend line. So lately, I don't give myself highest marks because the euro kept going down. But I'm not going to give up. I mean, nobody bats 1,000. But let me show you. I'm just going to show you what I see now. Okay, so here's the cross currents. This is my daily chart of the euro US dollar. Here's a downtrend I've had for a while, and even back here, just recently, this is what I'm talking about. I pointed out the triangle. I told you I expected an upside break. That didn't come, but I also pointed out the triangle and said, look, when you get a downside break, that's the nature of a triangle. That's bearish. And we got that. We broke the triangle. It was a beautiful, beautiful uptrend line, and the seller stepped in. And yeah, this all had to do with around the Fed meeting, but again, it's all intertwined. You just have to believe me on that the fundamentals and the technicals align, and I just judge which way this would break wrong. But again, it's not anything, it's not like I'm short the euro there. I'm using my analysis for the euro and the dollar to help align with my trades and the metals. So that happened, and again, it's like an ink block test. Those that want to see what they want to see. If you're a bear, you saw that breakdown at the time, and I saw it and I recognize it, and it certainly, technically, that was it. Everyone's perceiving Powell to be more hawkish than the ECB, even though he's way too dovish in my opinion and others. However, again, what I saw and I pointed out to you the other day was this. So erase all the other line here. We'll do it this way. Erase all the other lines. And so yes, while you had a triangle breakdown, you also put in a big divergent low. And this is a nice divergent low, and it's confirmed now with the bullish crossover, right? Very impulsive buying. Turn the lines back on. We regain the triangle, so that in itself right there is very bullish. That is a false breakout, right? You had the triangle pattern. Undoubtedly, a lot of euro bears and dollar bulls, took that trade, and now they're smoked. If they're disciplined traders, these are all stops being hit. And not only that, now you're starting to take out the downtrend line. So again, now look at this. You can remember this because it's important, because that was a false breakdown. So that is in itself bullish. It's bearish when the breakdown happened, but the fact it was proved to be a whipsaw or a bear trap, that's bullish. Now all those shorts that shorted the euro and went long the dollar, they're covering. And so that could be the fuel for a break out of this trend line and a rally up. Okay, now we're going to talk fundamentals again because they're intertwined. So what happened today? Bank of England raised interest rates for the second straight meeting. That was the first time they've done that since, hold on, let me find the article. Okay, sorry, it was the first back-to-back rate hikes from the Bank of England since 2004. Not only that, so they raised their rate. Look, I know they sound small, but they went from 0 to a quarter last time, and now to 0.5%. The panel was split. Let's see, there were 4 of the panel's 9 members wanted a bigger rise. They wanted to take it up to 0.75. Okay, so where am I going with this? Well, okay, I track the euro a lot because the euro is the biggest component of the dollar. It's basically inverse the dollar. It's over 56% weighting of the dollar index. So the euro again is an inverse to the dollar, and so you can either track the dollar, track the euro, do both. I do both. Okay, Bank of England. They for a while back, the England was part of the European Union with the monetary thing, and they went on their own, went back to the pound. So now you have the next door neighbor. You have England, just going unprecedented, not unprecedented, but the first time since 2004 doing back-to-back rate hikes. And of that, you almost got a 0.5% increase instead of another quarter point. If you had just one more panel member, that's what would have happened. Okay, so where am I going? Okay, sooner or later, and by the way, they did that. They cited this because they expect annual inflation to accelerate above 7% within months due to low unemployment, rising wages, and surging energy prices. So I think it's safe to say England's problems, to a greater or lesser extent, are going to be the rest of the European Union's problems. And so, by that logic, one would think that now the ECB is going to have to at least shift a little bit, at least pivot a little bit, right? That's obviously what's going on here. Again, this isn't the pound versus the dollar. I'm sure you'll see that chart going up. But again, I just wanted to make mention that because of the proximity. It's not like the Bank of Mexico just raised consecutive rate hikes. This is the Bank of England raising again. So the euro. Traders are going to cause it to go up in anticipation that Draghi's probably going to, look at another hike there soon, or start hiking soon. Oh, sorry, not Draghi. I mean Lagarde. All right, so that's we'll see what happens there. But take it for what it's worth. I just gave you a bunch of fundamental ramblings, whether it plays out or not. But what I can tell you is everything I just said here. That I can say with certainty that was a breakdown that proved to be a false breakdown. That put in a divergent low, and now we're just starting to crack. But the day isn't over, so you want to see that previous reaction high get taken out. And now again. Trade the euro if you want, trade the dollar if you want, but where I'm going here is looking at gold. So gold is in the same type of triangle pattern, a different one. On the euro, it had been in a downtrend, so you had a triangle pattern down at the bottom, which so far is, after a brief whipsaw, is about to break out to the upside. And in gold, we've been in a bull market since gold bottomed back in late 2015. That bull market started out with a little thump and then went sideways. This is a basing pattern here, consolidation, then broke out, had a strong leg up, and has been in now a multi-year, almost 2-year consolidation phase, and takes the shape of a symmetrical triangle pattern. And again, that can go either way. And yes, there could be a false breakout in one direction than the other, but take whichever one happens and just know that the nature of a triangle pattern, it's like energy building like a coiled spring, and you usually get a pretty powerful move out. And if everything I just spent 5 minutes talking about the euro pans out, we get more upside in the euro, downside in the dollar, and all that means is the ECB just has to start pivoting a little bit, like Powell pivoted a while ago towards from a very dovish to a more hawkish stance. And if you just see that coming with the ECB, Powell can still continue to raise rates, but then it should give strength in the euro, which means down dollar, and then that tends to be bullish for gold. So, and even the fact that gold has held up so much despite the falling euro recently and the rising dollar, says a lot. Says there's been an underlying bid to gold, demand for gold, that has offset the typical impact of a rising dollar / falling euro. So if you can align that and get the dollar falling and the euro rallying with increased, with demand for gold, more buyers and sellers, then that's what's going to finally take you out of this range and give you the next leg up in gold. And look, I've been beating this drum for a long time, and again, we have to break that out. And if we break down and go, that's it, then that's it. And the thing is, I don't have 100% of my portfolio in gold. I never have it 100% of anything. So I'm either going to be right or wrong here. And until we break out, like I always say, support is support until unless broken. Resistance is resistance until unless broken. So that's what you need. You need to see gold pop that triangle in about 174. and then it should be off to the races. And likewise, no bueno if it drops much below the bottom of the triangle there. And of course, silver tends to follow, and I've been favoring for the last several months when these rallies come, especially on the 60-minute charts. That's our timing. If you're actively swing trading, there's been plenty of swing trades highlighted and to be made while gold and silver have been doing this. That's swing trader. This is trend trading and investing. But this is what it looks like on SLV, the ETF, on a weekly chart. We were just looking at the weekly chart of gold, by the way, too, guys. So you have this downtrend line really from right here at this point. We've been building positive divergence. These two lows right there, equal lows, but with higher lows in the indicators. And you can see silver's got a really nice support level, price support level here, about 2072. We've had a couple of intra-week pops. Remember, this is a weekly chart, so those skinny parts, those tails on those candles mean nothing because you snap back up and regain that trend line at the end of the week each time here, and you pull it down just a little lower and get it nice and tight. Look how well it comes in. 1, 2, 3, 4, 5, the body there closed above. That's all that matters. 6, 7, 8, 9, 10, 11, 12, 13, 14 candles defining that level. So it's a big level. And then you have that trend line there. So anything much more than just a brief pop down, you can get that pop, a little whipsaw, and that would be bullish. So, but anything much more than that, no bueno for silver. Anything to the upside, if we can hold this, and you can buy it now at support. That's the thing. If you're bullish, and I talk about this all the time, if you're longer term bullish on the metals, this is where as a long-term investor you want to be accumulating. Yes, it's been frustrating if you've been buying here. I give you buy zones for a long time for long-term investors, trend traders. Silver doesn't pay dividends, nor does gold, but you're at support. And all I can tell you is objective to buy at support with stops somewhat below. Somewhat is relevant or proportional to your targets where you think it's going. If you think it's just going to run at new highs, that's one thing. But if we break that trend line after all this consolidation, well, yeah, that would be obviously a swing target, as with this one in the middle here. But ultimately, if we head up there, we're probably going to break out of that sooner than later. And likewise, if we crap out to the downside for whatever reason, then that's not going to be bullish, and it's probably going to bring silver all the way back down here at about 1758. But keep an eye on gold, keep an eye on the euro, keep an eye on the dollar, and we could be getting close to finally get a breakout of this, what I believe to be bull market consolidation. All right, let's wrap it up here, and then I will I don't know, continue looking around. I keep promising you guys the semiconductor trades. I need to get to those and finish that short list, and I'll get those out to you guys hopefully today before the close. This has been Randy Finney with Right Side of the Chart. Have a good one.